All right, everybody, welcome in. Welcome to another Voltz community call. Here we go. I see people rushing into the room. Look at this. Very cool, very cool. Okay, more people filing in. Maybe give it a few more seconds. Check. Cool. Let's do it. All right. Welcome, everybody. Thanks for joining another Voltz community call. Super excited to have you. This is going to be a really fun one. Today we want to give you a few updates on Voltz Protocol and the Labs team, as well as open it up to any questions you may have. So really excited to dive into the Risk Engine today with our lead Quant wizard, Mike. And we're also going to be checking out some really cool upgrades to the new UI. First, a few announcements and just kind of general Discord housekeeping. Uh, our most exciting announcement I want to give first, and actually Simon is going to announce this one. Simon, do you want to share?
Yeah, sure. The announcement here is that we've got a new member to the Voltz Labs team. He's called Alex. He's joining us as a software engineer, and he's kind of another kind of hackathon winner, kind of ninja software engineer, kind of graduating from UCL, so University College London, as his undergrad, and then has recently finished his master's at the University of Cambridge. So super excited to have him in the team, and you can recognize him on Discord as I think the only member in the team that doesn't yet have a lightning bolt at the end of his name, which kind of shows you just how recently he has joined. But we're really excited to have him here.
Yeah, definitely. It's super exciting to have him. Everyone give him a warm welcome, and I'm sure that lightning bolt will show up any minute now. So, uh,
Yeah, I didn't mean that as is the way of identifying Alex.
yeah, well, I'm seeing lots of lightning bolts in the crowd here, so that's awesome. And even on Twitter, we see lots of those. So keep them coming. It's a great way to kind of show your love and support for Voltz Protocol. So you may have noticed that this channel is now called Community Voice in Chat. That is because there is now a chat channel built in to the voice channel. This is a new Discord feature. So if y'all can see, I've just typed a message into that channel. So now, if you have questions you want to ask, you can type them in here. And let's keep this channel mostly for questions if we can, just to make it easier on us to find those questions. So we can keep our GMs in the appropriate GM channel. So exciting to use that. Another announcement regarding the storyboard NFT contest. They'll be going out in the next week. We'll also have a few NFTs left over, and we'll be sharing details on how to get a hold of those soon. You may have also noticed that we have a few new channels in the Discord. We are uh, you can see that there's a pick your skills channel and a find your team channel. These are ways for builders who come into Voltz to find other builders and find teams. So you can head into pick your skills. You can kind of pick whatever skills you identify with, whether it's front end, back end, design, DevOps, anything like that. And then you can head into the find a team channel and actually ping the roles that you're looking for. So if you're a project looking for a builder, you can ping the builders looking for projects. And so this system is a new system. Not many have tried this before, so we're kind of rolling it out gradually. And we'd love, if you're a builder, for you to hop in there, select your skills, and find a team. So that's just part of what we're doing at Voltz to kind of connect more builders to projects looking to build on Voltz. You'll also notice that we have a new layout for the language channels. So you may have noticed if you frequent our non-English channels, you might say, where's it gone? You can head down to the pick your language channel and pick the language that you want to speak, and you'll see a whole slew of channels open up in your desired language when you pick the appropriate language. So big shout out to the amplifiers helping out with that. And please let us know if there's a language you'd like to see, or if you can help moderate or potentially even translate some content for those channels, because obviously we want to be as accommodating as possible to our worldwide team here. With that, I think that's all of the Discord housekeeping notes we have. So I want to now bring on Simon and Mike to discuss the Risk Engine. So many of you saw our Twitter thread last week where we dove into the topic of leverage and how the Voltz Risk Engine allows large amounts of leverage to be made safely. So with Voltz, I mean, I'll let the guys get into this, but you might you might see that you can use larger amounts of leverage than you could on other protocols in a much safer way. So obviously, the topic of leverage is a big one, especially now with this bear market. I mean, people getting wrecked. You hear about these big firms getting wrecked. So the topic of leverage can be misunderstood at times. And we'll be diving deeper into leverage in our Twitter spaces next week. But first, we kind of want to touch upon this topic. And I first want to ask Simon a few fundamental questions about leverage. So, just in the hope of kind of educating our community, it really bears repeating that leverage on Voltz is maybe a little different than what you're used to on other protocols. So, let me turn it over to Simon. Let's start from the basics. What is leverage, Simon, and why is it so important with interest rate swaps?
Yeah, that's a good question. So I think most people, for what it's worth, I think are kind of reasonably familiar with the concept of leverage, which is essentially that you're depositing margin to cover a position, but the size of your trade is actually a lot bigger than the margin which you're putting down. And kind of at the most macro level, kind of what that means is it means that you get more exposure to upside, but you also get more exposure to downside as well. It's the opposite side of that coin. But when trading interest rates, it kind of unlike a token, which could double or half in value kind of very quickly in some instances, interest rates, they tend to move by smaller amounts. So kind of you're typically looking at basis points and can maybe at maximum like 8% or a few percent, which then means trading with leverage. Not only is that safer if you to say use the same amount of leverage as you would perhaps trading a kind of a perp on a token, but it also means that you kind of want to be taking leverage to really make the returns attractive. And I guess just to put that in context, if you were to have or do a rates trade where it were to move by say 10 basis points, that for you, if you don't use any leverage at all, it is actually kind of like relatively unattractive, if we're just being honest. But if you suddenly do that with 100x leverage, then actually it starts to become pretty attractive and you're able to make pretty interesting returns. And it's one of the things actually when kind of Archer and I were designing the protocol, we knew that just how important it is to trade rates with leverage. And there are like some protocols out there where you can get exposure to rates, and I think some of those innovations are great, but none of them enable you to do it with leverage, which basically means that you can't take advantage of and you can't deploy a bunch of like interesting strategies that take advantage of the way in which those rates behave and generate nice APYs, because if you don't have leverage, like the APYs are never going to be that attractive. So hopefully at a high level that helps explain kind of what is leverage and why it's so important for interest rate swaps.
Yeah, definitely. Thanks for breaking that down. So, I mean, like I mentioned, we're hearing a lot in the news about how firms being over leveraged leads to their downfall, essentially. Uh, I'd love for you to expand on how leverage interest rate swap positions are different from what we typically hear of as leverage trading positions in the news.
Yeah, I guess it's building on that same point. So if you were to take 100x leverage on a perp kind of associated with a token, sure that could double in value, at which point you kind of probably make quite a lot of money, but it could also half in value if not kind of lose 90% of its value overnight, at which point you've actually kind of massively amplified your losses. When people are taking leverage, as what we heard in the news, that they're actually doing it in various different ways, some of which were extremely illiquid, which has obviously contributed to kind of some of the illiquidity problems or insolvency problems that some of those firms have had. But just keeping it simple, if you were to take 100x leverage on a perp of a token over a token, you're exposed to kind of quite a lot of downside whilst you're also exposed to the upside. Whereas if you do that with rates, because rate movements tend to be a lot smaller on a relative basis, and because they also tend to exhibit some form of mean reversing behavior, which basically means if it drops, there is a reasonable chance it will also come back up again at some point in the future. It means that the actual kind of risk that you are exposed to from a downside perspective is comparatively lower. And this risk is basically what is typically described in traditional finance as value at risk. So VAR is the acronym. And I'm not going to steal Mike's thunder, so I'll let Mike talk through this. But value at risk is a concept which exists within the risk engine that we've built. And that enables us to basically prove that even with large amounts of leverage, that your ultimate value at risk is lower than if you were to take that same amount of leverage on something like a perp.
Great, yeah, and it's going to be cool to dive into the risk engine in a little bit. So, I mean, given the ways that kind of risk is a little bit different in Voltz versus other approaches and protocols, in your view, do you see leverage as being underutilized by current Voltz protocol traders and LPs?
I think the short answer to that is yes. And that is actually part of the reason why well, it's not the reason why we built the risk engine, but it's part of the reason why we kind of put an article out just explaining like how safe taking leverage can be when trading rates. So I think the actual numbers are on average, it's around 6x leverage people are taking on Voltz Protocol at the moment. And despite that relatively small leverage, actually, it's worth saying that I think within a few hours of us launching, we were the most liquid interest rate swap DEX, like in the whole of DeFi, despite a relatively small amount of leverage that people were using. But there's a whole load of analysis we have that instead of taking 6x leverage, it varies depending on the asset and the position that you're taking, whether you're an LP, a VT, or an FT. And then whether that's on AUSDC or CDI, etc. But there are instances where you could be taking over 100x leverage and still be pretty safe. Which, if you think about that relative to an average of 6, is actually a pretty big delta.
Right, right. And if people aren't taking leverage or taking too little leverage, then they risk their gains essentially being eaten up by gas fees. Is that correct?
Yeah, so if a rate were to move by just 1% for argument's sake, and just call it a year's term, if you're taking 6x leverage, you're gonna make 6% over the course of a year. And if that's on a small enough trade, then the gas fee could just offset that. But if you're taking 100x, and obviously people need to kind of understand this, which is the point of this call, to make sure they're making their own decisions around it. But if you were to take 100x, instead of you making 6% over the course of the year, you suddenly made 100%. So you've basically doubled your money. And at that point, assuming it wasn't off a like $1 trade, you're gonna be in a position where you're making more money than you're paying in gas.
Awesome, awesome. Yeah, that helps a lot with kind of understanding the situation at hand. Next, I'd love to turn it over to our lead quant wizard. I don't know why I keep calling him that, but it just seems to flow off the tongue. Mike here. He's going to come up and talk a little bit about the Voltz Risk Engine. Before we start, Mike, I'd love if you can tell us a little bit about your background and the experience you bring to the Voltz Labs team.
Yeah, sure. Hi everyone. Yeah, I'm Mike. A bit about my background. Essentially, I'm a sort of a data analyst, data scientist by training and by interest. I used to be a physicist. I have a PhD in physics. So this was essentially several years of doing, terabyte scale data analysis, lots of statistics, lots of machine learning, writing really hacky Python code, writing even hackier C++ code, things like that. And then I was sort of in academic research for a few years, again focusing on physics and mathematical modeling, and just understanding data really, really well. There's kind of a term that's bandied about, which is data scientist, and it can kind of mean everything and nothing. But essentially, I'm sort of a data scientist within the realm of physics. And then I got really interested in general kind of stochastic problems and stochastic mathematics, and that kind of led me down a rabbit hole of financial mathematics theory. So I sort of started teaching myself that, diving into financial math theory in kind of a big way in my free time, and I found I really quite liked it. So I made the jump and went into finance. So I was a quant at a TradFi hedge fund. So this is kind of where I cut my teeth in real financial trading. So I spent my days researching and building systematic trading strategies for these things called futures. This involved like lots of sort of looking for signals in lots of noise, building out models to predict how the market will move, understanding risk at a very deep level. So building, risk models, which we'll talk a bit more about later. All that kind of good stuff. So that's sort of what brought me then into Voltz as a quant in the kind of relatively new space of DeFi.
Yeah, amazing, and it's really incredible to have you on the Voltz team, and for me personally to be on such a team with someone with such an amazing background. We brought you in here today to, of course, say hi, but also to have you talk a little bit about the Voltz Risk Engine, because we know you put out an article last week on this and done a lot of fascinating work. So we'd love if you can share your screen and maybe give us kind of like an explain like I'm five version overview of the Risk Engine and walk us through what's been built.
Yeah, absolutely. Before I share, I'll just give a couple of comments on the general ideas, and then I'll dive in. It will be sort of I won't be running any code, but I'll just walk you guys through features on the Git repo that I think are worth pointing out. But let's take a step back before looking at the actual infrastructure. And just imagine I or you or whoever, we want to take a position on Voltz, and that could be like a VT variable take a position, or an FT, or whatever. And so what you could do if you had data is you could investigate how so let's say take a VT position, you could investigate how that position would have behaved using some historical data set. So you could just scrape some APY rates from 6 months ago and say, assuming I plug these APY rates into my model of Voltz, how would my position have done? Would I make money? Would I lose money? And you could go away and do that. But the problem is that historical data, it doesn't really capture everything in the market. It might not necessarily capture crazy market conditions like random shocks to the rates, or high volatilities, or coins to pegging, for example. It might not necessarily capture all those interesting features. So what you can do instead is you can actually simulate lots and lots of different market conditions using clever maths, and then you can kind of combine all of these different simulations into a super general synthetic data set. And with this, you can then simulate how your strategy going like VT, for example, would have behaved across all of these different market scenarios. And you can really have hundreds or even thousands of these different market scenarios. So you're covering a broad ensemble of different possibilities here. And then you ask the question, across all of these different market scenarios, how often do I get liquidated? How often do I lose a certain amount of cash? How often do I lose or become insolvent? So you can kind of work backwards from this argument, actually. And this now brings in the idea of leverage. So you can essentially estimate from all your different simulations the probability that you're liquidated. And let's say that you want to ensure that the probability that you're liquidated is below a number. Let's say you want to make sure that you're below 5%. Now, be it 5%, 10%, 20%, that depends on your risk preference. But let's, for argument's sake, you want to be below 5%. So you can do this, and you can work back my logic of simulations and ask the question, how much leverage can I afford to take to kind of ensure that my probability of being liquidated is below 5%. And this gives you now a kind of a safe bound on the possible leverage you can have. And so in the risk engine, what we try to essentially do is simulate the full Voltz trading logic, all the margin calculations, all the parameterizations, everything that's implemented in the light paper. And we kind of stress test it by throwing it through all of these different adverse market conditions. And then we work backwards and we calculate the possible leverages that we could see in all these different adverse market conditions. And then based on that, we arrive at a safe leverage to ensure that liquidations across the average of all of these different funky market strats is below 5%. So that's the kind of basic idea. I didn't want to talk too much about how leverage is important, how having leverage under control is really, is really, really important, because Simon's already touched on that. But that's the basic idea with the Voltz Risk Engine. So at its heart, it's a fully Pythonic implementation of Voltz. And with that, you can really stress test your particular strategy using all sorts of different simulated market conditions. So if I just share my screen for a minute or two, just to give you guys some more context.
Sure.
See, okay, you should see. Hopefully, you see the right screen. So this is the Risk Engine GitHub page. I think I'm sharing the right thing.
Yes, looks great.
Excellent, good. Yeah, so it's a pretty gnarly page with lots and lots and lots of different Python scripts. But essentially, there's one that really matters, and it's called the run simulator. So the essential principle of the run simulator is that you can give this guy lots of different possible parameters, which are defined in the light paper, and they are the parameters that control the behavior of the protocol. And then once you call the script with those different parameters, giving those parameters different values, you can also simulate your final P&L, your final sort of risk, and your final VAR, what Simon touched on earlier. So we can do this for just a straight set of parameters, but we can also ask the question, let's say I want to keep my risk within a certain bounds. What's the optimum set of kind of Voltz parameters that give me that capability? And so you can run a special optimization program with this script that actually performs this optimization using something called a tuner. And that works out for you the right parameters in the Voltz protocol that allow you to actually safely lever your particular strategy, your particular position. So, I mean, on this GitHub page, which is now public, there's a fairly extensive README that covers the logic behind the Risk Engine, how we use it to extract data and run simulations, how we use it to actually implement the interest rate swaps in Python, and there are 3 major classes to do that, and then ultimately how we use it to simulate particular positions of interest. So I won't dive too much more into the details on this. I think I'll keep it relatively verbal. But I encourage people who are interested to dive into the repo and to post questions and comments on Discord, and I'm happy to take questions and respond. So I'll stop my share and I'll get back to the main thread of the conversation.
Awesome, and you touched upon a little bit, and Simon did as well, this concept about value at risk, or VAR, and I know that's been borrowed from TradFi, but I'd love if you could expand on that concept a little bit and how it applies to the risk engine here.
Yeah, of course. So this VAR idea is really, really important. It's been used in TradFi for a very long time, over 30 years now, I think. But the idea is generally quite simple. So again, we go back to our kind of our imaginary trader who wants to put on a strategy, and over the course of deploying that strategy, let's say they deploy it over a 1-year pool, for example, they're going to make a profit, they're going to make a loss. Their P&L, so to speak, is going to vary from day to day, and they want to be able to simulate their expected P&L in the future. And so what they can do mathematically is they can generate a distribution of, say, possible returns, possible P&L values on like the 1-year time horizon. So there's some big distribution of returns that one can predict. And that distribution of returns is going to have both positive values and negative values. So the VAR is basically a measure of how large that kind of negative tail in your P&L is. That's the kind of traditional finance way of thinking about VAR. So if you open up or Google some bits on VAR, you'll read about people talking about things like 95% VAR. And what they mean there is the loss sustained such that I reach the bottom 5% of my P&L distribution. That's what it means. But we can extend this idea to variables other than P&L. And this is basically what we did with Voltz. So we constructed predicted distributions for the possible liquidity in the strategy and the insolvency. And in doing so, we can ask the question, what is the value of the downside liquidations and the downside insolvencies? So these are what we call the LVAR and the IVAR, respectively. And then these LVARs and IVARs, they are a function of the leverage of the strategy. So as you change your leverage, your VAR distribution shape is going to change. Your tails will get kind of fatter or thinner. And then based on that, you can work out what is the right level of leverage that gives me a sufficiently kind of thin VAR tail in LVAR or IVAR, such that my portfolio is kind of safe at, say, the 95% level.
Great, I see. So given the innovations with a VAR and what you've created here, how can Voltz users be confident that risk engine simulations capture all of the possible market scenarios that they might face?
Yeah, so we can't capture everything. It's of course impossible. But the nice thing is that there is a lot of clever stochastic mathematics in the literature, which we can use to simulate all sorts of different funky market conditions. So, for example, we took historical APY data and we used that to extract the historical volatility in the markets. And then we can scale that volatility to huge levels. In some cases, actually even 5 to 20 times the historical volatility. And based on those very large volatility scalings, you can simulate all sorts of different kind of market time series. So in terms of the envelope of possible volatilities, the risk engine covers a lot of different and kind of very broad possible market scenarios. And then in addition to the volatility itself, there's also, the associated effect of, different actors, different LPs, for example, putting in liquidities in different tick ranges. So we simulated the effects of deploying your notional in lots of different tick ranges, some very wide, some very thin, some at high rates, some at low rates. And, so kind of just trying to account for all of these different pathological conditions that can impact the concentration of liquidity in the protocol and also the general volatility of the market. So yeah, it's pretty broad on the whole in terms of what it tries to capture.
I see. Now, and as Voltz continues to grow in popularity, will kind of the real world user data go into refining the risk engine further?
Yeah, that's the idea. So I think we absolutely want to do this. So now that Voltz is on chain, we have access to potentially all of this nice on-chain data which we can scrape and we can plug into the risk engine. And actually, the way to think about the risk engine moving forward is that it's not just going to be simulating the risk profile of possible trades. It's going to be keeping a track of how the insolvencies and how the liquidations of our on-chain users are evolving over time. And so I think the analogy I like here is that if you go to any hedge fund or if you go to any investment bank, they'll have a team of, like 10 different maths PhDs all working in the quant risk department. And those guys are basically eyeballing, covariance matrices all day. So you have these 10 maths PhDs really checking the risk, really understanding day by day how the P&L changes. And basically they're compiling reports and they're producing reports for the fund or the bank every day, or often every week, on how the bank is performing. And so they're actually keeping track of all the risks associated with all the trades. And we want to do the same ultimately at Voltz with this risk engine. It's just that instead of having 10 maths PhDs poring over all these bits of data, you've basically got me.
Well, it sounds like
we got you, Mike, and also we're automating a lot of stuff, which I think is obviously going to make a big difference as well. But yeah, it's making it scalable is obviously extremely important.
Yeah, well, it sounds like the risk engine itself is at least 8 or 9 math PhDs right there, just automated. So really fascinating stuff, Mike. I know you've shared a lot here. I just want to pose one more question. You touched upon this a little bit, but I just want to ask you about what kind of the future optimizations that are possible with the risk engine and what we can look forward to as time goes on with this system.
So the nice thing about the risk engine is that it's a general sort of system. When you optimize anything, you optimize it according to the value of some function. At the moment, the function that we optimize on in the risk engine is basically saying, I want to maximize the mean leverage across all of these different market scenarios, whilst ensuring that my LVAR and my IVAR are below a certain value. So, for those who kind of know a bit of stats, we essentially like to use the VARs to regularize the objective function, where the objective function is to maximize the mean leverage. So this is, of course, just one possible objective function we could use, right? And there are all sorts of different variables we could add in future. So say I want to test my crazy hot new trading strategy. If I'm deploying a strategy, what do I care about? I care about the ratio of returns to risk. That's the Sharpe ratio or the information ratio. I care about the maximum possible drawdown I could see in my simulation, so I could actually calculate those variables and plug them in. So I think moving forward, we want to extend optimization to include how we could actually optimize our particular trading signals. So adding in features like optimizing Sharpe ratio, optimizing information ratio, optimizing maximum allowed drawdown and drawdown duration, those sorts of things. So the typical quantities that you hear bands about in your hedge fund.
Great, great. I want to ask Simon if you have any kind of follow-ups you want to ask Mike before we move on to checking out our changes to the UI.
I don't think so. The only thing that I was going to say is obviously there'll be some people listening to this call, hopefully a lot of people listening to this call that are super excited about what Mike just showed off, and may even have thoughts and comments on how it could be improved. Mike, do you want to just talk to the fact that we've made this open source and how people can reach out and contribute and that type of thing?
Yeah, exactly. So again, unlike in your investment bank or your hedge fund, where the risk management is kind of the secret of the quant risk department, here we've made our risk management open source. So you guys can clone it off Git, and you can add to it, you can modify it, you can add additional simulations, and we're really happy to hear from people and suggestions on how to improve it, how to refine it. We've already had interest from a number of other guys in the DeFi space who basically want to build on the risk engine and use the risk engine to do additional cool simulations of things, more general IRS pools, maybe even extending and simulating different sort of fixed income instruments. How would, for example, simulating caps and floors look within the risk engine, that kind of thing, interest rate spread, so on and so forth. So yeah, we've made this open source in the spirit of kind of sharing really in an entirely open way how we manage our risk, and are really excited and happy to hear from feedback and people suggesting improvements.
Yeah, and I think the thing that I'd add to that is obviously we've deliberately built the protocol so that obviously the risk engine aside, like the protocol itself is obviously all on chain and deliberately built in a way that makes it composable and can be kind of decentralized over time. The risk engine, which Mike has been kind of talking through and explaining, basically that kind of feeds out a bunch of parameters where you set those parameters in the future via governance votes in the protocol itself, and that basically defines the amount of risk and therefore leverage, etc., that can be taken within the protocol. So what we're really keen to happen is obviously we want Voltz as to be kind of a primitive that is ultimately a public good and owned and managed by the people that use it. As part of that transition to becoming a decentralized piece of infrastructure, we obviously want the community to start to understand the way the risk management works, such that the community as a whole and as a DAO and as a complete group, we can be voting on kind of governance changes off the back of risk simulations and that type of thing in a decentralized way. So it's not dependent on Voltz Labs.
Yeah, amazing, and really a lot to look forward to here as we kind of gradually build the DAO and all take part in this infrastructure together. And just a reminder, you can drop any questions for Mike or Simon into the chat channel, which is built into this voice channel now. You'll see a little chat box in the upper right corner. So now we are going to check out some cool upcoming updates to the UI. We're going to check in with the legend, the man, the myth, the legend, Brokoli, and see if he can hop on and share his screen for to check out this UI here. Brokoli, do you read me?
Hey, do you read me back?
I read you loud and clear. So awesome. We'd
Nice.
love to check out this UI because obviously there's a lot going on in the back end here, but what does it all come down to in the day-to-day use? It comes down to people's experience of the UI. So let's see what
Yeah,
Broccoli has in
totally.
store.
Yeah, I mean, I feel like after Mike speaking, I don't know how can I keep the excitement up, but I'll try. We can go from Risk Engine to pushing pixels and colors. Everyone likes colors. Do we want to see, what do we want to see? What's upcoming or what we actually deployed recently?
What we've deployed, yeah.
Yeah. So, few things first. Maybe it's worth explaining like what's been our approach so far, which basically we wanted to have this novel protocol that enables ARS swaps to be possible on chain. And on top of that, we wanted people to be able to use an interface for that. So that was the first functionality that we wanted to enable. And now the work we're putting a lot of effort on is like how we improve that. How improve the user experience, how improve the whole product, and something we've been very eager to get, and we're getting a lot, is feedback from all of you. So we've been reading everything that you send. We've been hearing to everybody who's reached out with a lot of relevant feedback, and we're trying to digest everything that you guys telling us, and we're picking the ones that we believe have the larger impact. And we have like a very long solid pipeline of things to work on, but we've already tackled some that actually are very related to what Mike was explaining with leverage. And I'll show you in a bit on why we're taking that approach. But I want to iterate how all process regarding the UI, we're trying, maybe this is unpopular, but we're trying to be the closest we can to Web 2 on how you build products, which has been very iterative, collecting feedback fast and qualitative one enough that we can keep improving the product, although the contract side of things is a bit more heavy to change, and that maybe requires like different feedback loops, and it's not that easy. But the UI is something we can't always control, and that we do want to make better every day. And there's a lot of them on the pipeline, as I said. I'll just walk you through couple of improvements that we've already launched and explain you why. Let me share my screen first. Unlock my MetaMask because I'm gonna be collecting some stuff. There we go. Cool. So let me share my screen. Is this the right one? Go live. Yes. Can you hear it? Can you see it? Sorry.
Yes.
Yeah. Nice. So hopefully you all quite familiar with Voltz UI at this point. There's been few changes already, not regarding the main screens yet, but more on like the transaction window. So that's what we call this one here. Am I connected? Yeah. So there's few things that we've added, and I would say they divide into two main reasons. One is how to visualize the risk engine in action. There's still some work to do on that front, but we wanted to make sure that people can understand that leverage is a big part of what we're building here, that this is still safe to use, like pretty huge leverage. And we wanted the UI to bridge the gap of like how the protocol works behind the curtains and what can the UI teach you without you having to figure it out. If you've been using Voltz up until now, you would see that we didn't have this leverage section. We basically had notional annual margin. So now what you can do is, if I were to choose like 1,000 notional, for instance, the UI will dynamically update already, and it will tell me like in this gray out area, it will tell me that I'm already applying some leverage, but I'm not really utilizing Voltz the most possible or efficient way that I can. Whereas if I'm on the green zone, that starts like making more sense, even though I'm on like a 50x leverage or approaching 50x right now, 50.1, which in general it would sound crazy, but we have Mike, which you said in all places they count like for 10 people doing what you do. I think you count for 10. So Mike has been building all of that. And we try that the UI tells you exactly how safe you are in your position, and you see the margin will also automatically automatically update based on the notional you input there. So you will be able to like play around and say like, actually, my balance in my wallet right now is 150. Maybe I go 100. Where's the one here? And as you see now, my leverage is like way down to only 10x, and I'm not using the whole power of Voltz, which is what we want everybody to understand. And at this point, I could just like go towards the green. I'm at 61x. My margin will go down to 16. But basically, that's what we're trying to UI to help people understand. So if I was to do the same on variable, if wanted to go here 10,000, obviously now I'm above the margin, but I could say that my minimum required is 21. Is the UI is telling me down here, so I could go like 23 for instance, and I'm on the safe position there using a 434 x, which is not that bad, pretty high. So yeah, that's how we implemented the leverage, and that was like a lot of feedback we've been getting, how the relationship between notional and margin work, and how healthy your position is before you open it. And then on top of that, something we're also deploying, and it's already live, is what we call quality of life improvements. So as you're using the UI, what things can we change that make your life a little bit easier? Input states, now they all working as intended, and it's easy for the user to see which one you're using. There's error states added as well. Also, we had a lot of feedback regarding tokens that you might be using or tokens that you might not be using. So we added next to the input field the token that you're required, and the app is also now checking the balance in your wallet, and it's able to tell you how much you have, so it's easy for you to just decide. And yeah, that's pretty much it that we've been just deployed very, very recently. We have a lot. I'm very excited. Like I've seen a design what's coming up, and I really want everybody to see it. Obviously, we're not going to show it, but I'm very, very excited for what's to come. So yeah, maybe we move into questions if there are any.
Sure, yeah, that is awesome. I mean, having the leverage slider is so important to just using the UI and understanding the health of your position. So yeah, now I'm going to turn it over to any community questions you have. You can drop them into the community voice chat channel. Is anyone building market neutral Voltz strategies for Voltz? That's already been answered right in there. Yes. And if anyone wants to expand on that, they're welcome to. So I just saw you on mute, Simon, so go ahead.
Yeah, I mean, it's one thing which I was going to talk about just more generally anyway, in terms of what's coming next for Voltz and what people have opportunity to get excited about. So I think there's kind of very broadly three kind of big things which are on the horizon. The first is that we are going to be releasing more trading strategies. So for those that didn't see the tweets that got sent out around how you can do statistical arbitrage across different kind of stablecoin rates of return. We can share that again. We'll probably put it in general straight after this. But we're going to be releasing a few more strategies that are obviously different to that, but in a comparable format. And then alongside that, the other two things which are going to be happening is the second is we will be taking those strategies and actually building out the code, making the code open source. But also, to respond to that question, we're going to be launching those strategies in Voltz, the more traditional Voltz, not the protocol Voltz. But they're going to be in a bunch of kind of like yield aggregating Voltz, so that people can just invest into them and kind of reap the benefits of that strategy. So that's something which is pretty exciting on the horizon. And then the third thing is new markets. So we kind of put out in the press release when we launched on the 1st of June that we will be doing things like Lido. I think it's relatively well known that there will be liquid staking markets which will be launching on Voltz pretty soon. So those three things combined are basically things to look forward to in the coming weeks.
Amazing. A lot to look forward to. And unless there's any other points to add, I think that's That's it for today. Amazing call. Big shout out to everyone that joined. Any other points to add in before we close?
Not for me.
All right, great. Well, thanks everyone for joining. Big shout out to Mike and to Brokoli for showing up and showing us what's new, and also Simon as well, of course. So thanks everyone. Enjoy using Voltz, enjoy using that leverage slider, and we'll catch you at the next call.